Hello friends and welcome to Finance Logic YouTube channel. My name is Evgeny. I'm qualified expert in finance with an experience of working with big-time consulting firms. In this video you will find a quiz, but this is not just an ordinary quiz because I will provide you with clear explanation of each question and you can upgrade your financial skills. This test is relevant to CFA exam of corporate issues, and if you are preparing to the exam, this test will be very helpful for you, and it would be very helpful for you even if you just want to upgrade your professional financial skills. And here are the rules of our test. The topic is corporate issues. You will have 10 multiple choice questions. You will have 15 seconds or more. You can just press pause and stop me and think more. Only one option is correct. If you're ready, let's begin with question number 1. The stakeholder group that bears the greatest amount of business risk of the company is debt holders, shareholders, or senior management. 15 seconds. Of course, the greatest amount of business risk is attributed to shareholders. Shareholders bears the risk that is greater than a risk of any other stakeholder. Just because debt holders get their payback or pledge, collateral asset, senior management gets its salary and bonus. And shareholders just get dividends, but it is on residual basis. Question number 2. A conflict between corporate stakeholders is least likely, pay attention, least likely, mitigated by stock options for management, stock dividends for shareholders, covenants imposed by debt holders. 15 seconds. And the answer is B, stock dividends for shareholders, because by substance, stock dividends are simply stock split. It is just a technical dilution of shares when we have one share and instead of one share now we have 100 shares. But it is not the way how conflict between stakeholders, conflict between management, debt holders or creditors and shareholders could be mitigated. Instead, stock options for management can align interest of management and shareholders, and covenants imposed by debt holders align interest of debt holders and the company. Question number 3, it's numerical. An investment's initial outlay or investment is 1.7 million. The investment will give cash flows of 230,000 USD per year in perpetuity. The project's internal rate of return is closest to 15 seconds. Well, some people wrongly think that to get IRR we need some discount rate, but it's not true. To get IRR we just need to estimate annual return that project promises. In this case, our return is 230 from the investment of 1.7 million, and this is exactly 13.5% as an annual rate. It has some disadvantages. IRR has some critical assumptions that we need to be aware of, but it is let's keep it outside this quiz. Question number 4. Which of the following statements is most likely accurate about a project? If net present value of project is greater than 0, its profitability index should be 0. The net present value, if net present value is less than 0, its profitability index should be less than 1. And if internal rate of return of project is 0, its net present value using discount rate k greater than 0 will still be 0. 15 seconds. PI, or profitability index, is estimated as present value of our future cash flows divided by initial investment. So obviously, if net present value is positive, and net present value is a difference between present value PV and investment, then our profitability index is positive. It's not 0. And now let's pay attention to option C. Internal rate of return is 0, meaning that project earns 0% per year. And if we discount our project, discount our cash flows to get net present value using rate greater than 0, of course we will get negative net present value. And the correct answer is B. If net present value of project is less than 0, then its profitability index should be less than 1. I need to add that in some sources you may find that profitability index is estimated as net present value divided by investment. This is also an option, but in this scenario we assume that profitability index is estimated as present value divided by investment. But whatever our formula of profitability index is, we still can use profitability index in order to make ranking of projects in order to allocate limited resources between several projects and to get the highest possible net present value. Question number 5. Which of the following action is most likely related to a secondary source of liquidity? Collecting accounts receivable, taking advantage of supplier financing, paying on day 40 instead of paying on day 10, and issuance of equity securities. 15 seconds for you. In simple words, when we need money to pay our liabilities, the most obvious way is to collect accounts receivables. It is what we have to do on a daily basis. It is our primary source of liquidity. This is cash that we earn on a regular basis. Taking advantage of supplier financing, we can say that it is primary or secondary, depending on its cost. In general, primary sources are the sources that are cheap, that cost less, and secondary sources are sources that are expensive for a company. Among these three options, of course, the most expensive one is issuance of equity securities, because it requires to spend some money on the issuance process, and we take money from shareholders, from owners, and cost of equity is the most expensive source of finance. Next question, question number 6. Which issuer company is the most liquid based on the quick ratio? 15 seconds. When we estimate liquidity, it's always useful to measure liquidity using liquidity ratios. Among them, the three most popular are current ratio, when we use all current assets; quick ratio, when we use current assets minus inventories. We exclude the most illiquid asset, which is inventory. And cash ratio, when we use only cash and some marketable securities that are more or less cash equivalents, to measure how we can cover our current liabilities using specified asset. And in this case, we need to take into account cash, marketable securities, and trade receivables. So we need to take all current assets and exclude inventories, and exclude also prepaid expenses. Because prepaid expense, it is not liquid, we will not get money from realizing of prepaid expense. We will get some service, or we will get inventories. We exclude inventory, and of course we have to exclude, using the same logic, prepaid expenses. In this case, the most liquid company is Alpha, because it has quick ratio, which is higher than quick ratio of remaining two companies. Question number 7. You need to fill the sentence. The objective of unit economics, price discrimination, functional separation. 15 seconds. Send the counting down this time. When you have different customer groups which have different willingness or ability to pay, it's very useful to set different prices to maximize profit. And setting different prices refers to price discrimination strategy. The very important condition of successful application of price discrimination is that our groups cannot interact between themselves, meaning that they cannot sell or resell our products within these groups, because otherwise the group for which we set lower price can gain by reselling our product to another group of customers which have higher willingness or ability to pay. Usually utility companies follows price discrimination strategy when they set higher tariffs for business, for industrial companies, and lower tariffs for population, for households. And if we refer to unit economics, we refer to such metrics as cost of customer acquisitions, client lifetime value, and so on. If we refer to functional separation, it is entity function model. It is nothing about different prices and profit maximization. Question number 8. Which of the following is least likely, pay attention, least likely, an appropriate method for an analyst to estimate a firm's target capital structure? Use the firm's current proportion of debt and equity based on market values with an adjustment for recent trends in its capital structure. Use average capital structure weights for the firm's industry based on book values of debt and equity, functional separation. Question number 8. Which of the following is least likely an appropriate method for an analyst to estimate a firm's target capital structure? Use firm's current proportion of debt and equity based on market values with an adjustment for recent trends in its capital structure. B. Use average capital structure weights for the firm's industry based on book values of debt and equity. Or C. Use the firm's current capital structure based on market value of debt and equity. 15 seconds. Pay attention again, that question is about least likely method. And it's about target capital structure. So, in A, we have market values of debt and equity, and we should know that market values are the most relevant to estimate capital structure. When we talk about capital structure, we of course can refer to book values, but the right way to analyze capital structure is to look at market value of equity and market value of debt, because only market values refer to real amount that we need to invest in order to be able to acquire in the entire business. And the problem of book values is that usually equity book value is usually much lower for the most companies. Its equity book value is much lower comparing to its market value. And in options A and C, we have references to market values. But B is about using book value. Of course, it makes sense to look at industry capital structure, but it's not useful to use book values of debt and equity. Correct answer is B. Question number 9. Alpha Co is the same line of business as Beta Co, which trades more frequently and has beta of 1.2. Alpha's Co debt to equity ratio is 2.0 and Beta Co debt to equity ratio is 1.6. Both companies have a tax rate of 30%. For Alpha Co, the analyst should use an adjusted equity beta closest to. Of course, 15 seconds is not enough. Stop me if you need. Before we go to correct answer, let me give you some fundamental basis. We have equity beta. Equity beta accounts for risks that we may call systematic, market, or non-diversifiable, meaning that it's impossible to avoid this kind of risk. It is risk about how changing markets, changing in general economy, how this change affects particular firm. And equity beta consists of two types of risk. First one is business risk, which is accounted by asset beta. Business risk, it is about what company does, in what industry it works. And next component of risk is financial risk. It is about how companies finance. More debt, more fixed payments in future, and accordingly greater financial risk. And financial risk of Alpha Co is greater than Beta Co because it has higher debt, it has more debt in its capital structure. And obviously, equity beta of Alpha Co should be greater than 1.2. It's obvious. So we can exclude B. It's obvious. Because beta equity includes two components. And if we talk about similar companies working in the same industry, we assume that they have the same asset beta and they have the same business or industry risk. Now, to answer the question, to select between A and C, we need to apply a single formula 2 times. The formula looks as follows. We estimate equity beta from asset beta and we add financial risk. We multiply it by component of financial risk. If debt is 0, you can use the formula and you can look at the formula. If D is 0, D is debt, then these betas are equal. So first, we need to apply this formula to get asset beta, because we know that equity beta of company Beta Co is 1.2. We know tax rate, we know debt to equity, and using backward estimation, we get 0.57, which is one of the options, but it's not correct option, because we need to go for a next step and apply the same formula, but to get equity beta of alpha, applying debt to equity ratio of alpha, which is 2.0. And equity beta accordingly is 1.36. And finally, question number 10. Which of the following causes of an increase in return on equity is most likely a positive sign for a firm's equity investors? It means that sometimes we may observe increase in return on equity, but it could not be described as a positive sign for equity investors. Net income is increasing at faster rate than book value of equity. Net income is decreasing at slower rate than book value of equity. Or firm takes bank loan to repurchase equity. 15 seconds. Well, increase in return on equity would be the most beneficial for equity investors if it's not associated with a significant increase in risk. Option C assumes dramatic increase in financial risk because company takes bank loan. Taking bank loan means having in future fixed payments, which are independent from company's performance. That is why C is not correct. It is very bad thing. It means that shareholders get increasing financial risk. So now let's compare A and B. Which one is better? Of course, it's better than net income is increasing faster than book value of equity, because return on equity is estimated by net income divided by book value of equity. And for us, it's good that net income is big and book value of equity is small, because book value of equity determines amount of resources that company uses to earn net income. And A and B are associated with increase in return on equity, but this increase is more beneficial when we observe growing net income, of course, than decreasing net income. That is why correct option is A. Now, what is your score? We had 10 questions, and now you can share in the comments your score, and I can give you the following interpretation of your result. If you have 8, 9, or 10 correct answers, your result is perfect. If the correct number of your answers is between 6 and 8, your result is good. And if you are preparing to CFA exam and your result is less than 6, you need to study harder. Share in the comment your result. Ask me about any examples, any quizzes that are not clear for you. Maybe you didn't get some explanation. I'm happy to answer all of your comments. Don't forget to subscribe, and see you in next videos. Bye.